And we kind of knew this was coming, right? Sandy hit a couple of weeks ago. You saw the devastation, you saw the damage. We've all been affected by it here. We knew it would start showing up in the data, and today it has. Jobless claims came in this morning at 8:30 a.m., up much more than expected. Good morning, everyone. Welcome to the Markets Hub. I am Paul Vigny. To help talk about this story today, Phil Izzo is with me. Phil Izzo, the journals. Phil Izzo, you still doing real time? Or
oh yeah,
yeah, you're still a real time guy, right?
Still within my
real time economics blog. Great, almost as good as the Market Beat blog.
Not
quite frankly.
I mean, listen,
you know, but let's not talk.
We
about
don't
that.
have the tag team of you and Bruce alone.
Right.
So.
Oh yeah, nobody could beat that, right? All right, let's talk about the claims.
Yep.
We knew those numbers were going to be up. We
Yeah.
didn't know they were going to be up that much.
Well, you know, part of the problem was that last week was depressed because of the power outages in New York. People weren't able to file like they normally were. So in addition to the people who were out of work because of the hurricane, there were the people in New York who were out of work who couldn't file and are filing this week. So that boosts it like another level.
Yeah.
So in addition to the people who are directly affected by the hurricane, there are the people who, you know, were out of work anyway, who we didn't count last week.
So it's sort of a catch-up for those people in terms of filing claims.
Exactly.
Now, we know these are seasonally adjusted numbers.
Yes.
Is part of this also because these seasonal adjustments don't account for a storm coming in?
Exactly.
So it skews it off even more?
Well, I don't know that the seasonals totally, you know, skew it even more than it already is. But the problem is the seasonals are already taking account for the usual activity around this time, and throwing a lot more claims in there just makes things a lot worse.
And I would think the usual activity this time of year is a lot of people getting at least part-time jobs because it's the holidays, right?
Right.
So claims would be lower.
Usually claims are a bit lower around now. They pretty much stay low till next year. The biggest problem with this is that claims are going to be a virtually useless indicator for weeks because it's going to have Sandy issues, and then it has lots of seasonal issues after the holidays and around the holidays. So between those two things, it's going to make it really hard to use claims as, you know, a reliable indicator going into next year.
Right. And well, actually, it kind of gets to what I was going to say next, because look, everybody knew the storm came, right? I mean, everyone, all the economists started plugging in the storm. Nobody thought the numbers would be that high.
Right.
I mean, I think it was expected about 20,000.
Well,
the rise was supposed to be
problem
about 20,000. It was almost 4 times that.
Well, they don't know exactly how to account for it. They don't know how many people are going to be affected. Probably in the next coming weeks, they'll have a better sense of who is affected, how many people in the region are affected. The best they can really do is take past hurricanes, and we've never had a hurricane in this area before that they can
not in our
use.
lifetimes.
Exactly, and we're so densely populated in the East Coast that it's really hard for them to get a sense of how much it's going to affect things. They'll probably be able to see continuing claims over the next couple of weeks. We'll give them a better idea maybe, and they'll be able to adjust for that. But at the same time, things are going to be confusing. And the biggest problem really is that we don't know the underlying trend because of these distortions. And it could be that there is some weakening in the job market, but we just don't know. And I mean, that's the problem we saw with retail sales the other day. They were also a bit lower. We blamed it on Sandy, but we're not positive that it was all Sandy. There could be some weakening because of the fiscal cliff.
To some various extent, we're going to see this in all the data, right?
Exactly.
I mean, to the extent that the New York region is a big part of the national chunk.
We make up more than 15% of the nation's economy. So there's going to be distortions in pretty much all the data for the next month and a half, and that's going to be really hard for us to tell.
And then quickly, we got 2 regional Fed reports this morning, right? We got the Empire State and the Philly Fed, both in the affected areas.
Yes.
Were those numbers? Did those numbers reflect Sandy?
Yeah, those were really, really weak reports, both from the Philly Fed and the Empire State, and that's primarily because those regions were the hardest hit by Sandy, and that's probably going to continue for a couple of months. And the funny thing is, while we have the hit from Sandy, there's going to be some increases in indicators coming early next year and even late this year because of construction efforts and people going out and buying replacement things. And so the funny thing is, we're going to have a really hard time seeing the underlying economy well into next year in all the data, not even just the jobless claims.
I mean, that's a problem given where we are right now.